let's find out what our first guest has to say about the world of cable and cutting that cable cord. Let's introduce Mike McCormack from Nomura. Mike, good to have you with us on Surveillance. Thanks for coming in.
Thank you, Pimm.
You know, we've always been talking about cutting the cord. That was the big theme, at least in the last 12 months. Have we moved on to something else?
Yes, I think the key debate on cutting the cord is really centered around this Netflix idea. And certainly we've seen a tremendous number of new subscribers coming on. There was, I think, a bear case centered on the cable TV industry on the idea that sub counts had been down. Some of the work that we have done would indicate that there was a digital transition in 2009 that pulled customers forward into 2009, making 2010 look a little bit weaker. And we think, as we enter 2011, and certainly the numbers are showing it, that we're seeing a recovery in Q1, and we expect that to continue through the year. So there were some optics issues, and what we're seeing now is that these over-the-top concerns are more focused around, are we losing video-on-demand revenue, premium channel revenue, and that's something we're watching closely.
Well, what are you seeing in terms of pay television? Are more people signing up for pay video, whether it be from a Netflix or indeed getting some kind of video on demand from Comcast or Cablevision?
We're seeing growth across the board. And Netflix, which we don't cover, but they added over 3 million customers this most recent quarter, so still very strong growth. Yet at the same time, we're not seeing the weakness on the pay TV side. And we can talk about cable stocks, but also telco stocks, because AT&T and Verizon are also in the video business. And we saw surprising strength in Q1 to the tune of over 500,000 net additions in video subscribership. So we would expect that number to be coming down and moving into the Netflix model if, in fact, that model is taking over share of traditional pay video.
All right, well, let's take a look at Comcast for just a moment. And we've got a chart of Comcast, the shares having gone up, enriched investors. They've made the NBCU deal a reality. They had to spend a lot of money, though, for the content. I believe it's about $300 million of money that maybe people weren't expecting they were going to have to send in order to get that growth. What about spending, and what about their cable business?
Yeah, the most recent quarter introduced some surprise, and I think people looked at it and said, well, is this incremental spend, or is this part of just the overhaul of NBC generally?
What do you make of Dick Ebersol, by the way, leaving NBC? I mean, he was the one that negotiated the Olympics contracts for NBC. Is that an issue?
It certainly calls into question whether or not NBC will retain Olympic coverage. And I think there's some confusion, I think, as to what the relationship was. And I think Dick was generally concerned for his contract, which is getting dragged out, and that's the reason he left. But you've obviously seen tremendous amount of shakeup in the NBC organization. And Jeff Zucker leaving clearly in favor of the Comcast crowd. So not surprised by that, but I think that Dick Ebersol was a bit of a shock today. But with respect to the programming costs, some of those have already been absorbed in Q1, so it's not really a pure incremental $300 million. And I think NBCU is sort of maligned rather in the marketplace, saying you haven't done the right things, we need to fix them. Our view on that is that on a going forward basis, there's an opportunity here for Comcast to capitalize not only on an NBCU valuation, they picked it up really at the trough, but also some of the theme park opportunity that we put a note out yesterday talking about this opportunity, which is Blackstone owns half of the theme park business, and there's an option for Comcast to take, or NBCU to take out the rest of that.
Do you think they will?
We think they will, and they've got about 30 days to make that decision. And by our math, it could add a significant increase to EBITDA in those businesses. So we think it's going to be a really good deal for Comcast.
So what kind of money would Comcast, NBCU have to actually stump up to take the theme parks away from Blackstone?
Well, I mean, I think you're going to be looking at a multiple, the Harry Potter theme at the theme park has done very well. And we've seen attendance at the theme park increase by almost twofold. So EBITDA at that business is growing rapidly. We think it could be $600 million by year end. And we think a 7 to 8 times EBITDA multiple attached to that is appropriate. So they would be on the hook for roughly half of that to Blackstone.
You think investors, though, are saying, please, Comcast, give us some of that money back. You've got the cash flow. We've been waiting for it for years.
I think the argument can be made both ways. I think in retrospect, Comcast's move to take out NBCU at trough valuations is now viewed quite positively. At the same time, investors do want money back. And we've seen time and time again companies being rewarded on share price by doing that. And I think Comcast can make a very good argument that they're doing both. We've got a very strong share repurchase program. They increased their dividend by 20% last quarter. So I think they're doing a good job at diversifying their base and really rewarding shareholders at the same time.
And you think people ought to buy the shares of Comcast? You got a buy rating on the stock.
We do. Our favorite picks in the cable industry right now are Comcast and Cablevision. And our view on that is that you've got opportunities for both companies from a catalyst standpoint. So with Comcast, clearly we have a positive view on the NBCU transaction, but also free cash accretion coming out of the business on an ongoing forward basis. With Cablevision, there's a rainbow spin coming up, we think, sometime at the end of June. And we think that's going to be a really strong catalyst, particularly if Rainbow is viewed as a takeout candidate, which we think near term it will be. So the multiples attached to that currently embedded in Cablevision's price, we think are not really appropriately valuing the business.
You were just talking about how in your household you subscribe to multiple services, whether it's Netflix, whether it's cable, whether it's satellite. How are people going to rationalize spending anywhere from what, maybe $100 to more than $200 a month on multiple services that many may not even watch or use?
Yeah, I think, unfortunately, for my household, it's highly uneconomical. But I think it comes down to...
You say your son said take out the DirecTV before he takes out the Netflix, right?
Right. So I think you're seeing generational differences in how we consume video product. And I think the balance of my family prefers to watch TV, although most of its time is shifted. And I think, frankly, if I were to have a triple play bundle, I would get better economics for ourselves, and yet you'd probably end up dissatisfying somebody in the household. But that being said, I think when we think about these things, ideally, things would work in the Netflix world. We would have maybe potentially an Apple TV that's 55 inches on our wall with one cable, a power cord, that's it. Everything else being carried over the broadband pipe and delivering whatever you want. The challenge with all of this is that the programmers are having a tough time figuring out how to make money. So thinking about the satellite providers, the cable providers, they're sort of the golden goose for the programmers. And going on these over-the-top products and trying to get paid in that fashion is much different and much more challenging. So I think that's the debate that's really going on behind the scenes.
When do the cable operators start charging people based on what they actually consume rather than a flat fee per month?
Well, this is a debate that sort of centers on the a la carte issue.
Right.
And it's been brought up with the FCC several times. The problem is it's very hard to create a business model around that. And it comes back to hurt the programmers, because ideally, maybe folks like you and I would prefer to watch Bloomberg, some news, and live sports, and ESPN. That's all we want. Very difficult to create a bundle that makes sense from a programming standpoint or programmer standpoint. So it's more economical to provide a bigger bundle and charge more for that bundle.
All right, well, one of the bundles that Verizon is offering is their Fios bundle. Their promotional pricing, I think, is $99.95 per month for the first year. You can cancel anytime during that year. Is that $100 price point is now the point to beat for all the competitors?
There have been some competing triple play offers at $79.95, so seeing some very significant pricing actions in certain markets.
Can they make money at that?
Well, that's the debate among cable versus telco. So we understand that the telcos have been in this business for a much shorter period of time, so their economics are not as good. You need broader subscriber base to get better economics from the programmers. So if you're thinking about the industry differences, the telcos are taking it on the chin from a margin perspective. Cable guys and satellite guys have an inherent advantage based upon their scale. So it's much more difficult for the telcos to make money at that level. The other thing we're seeing, though, is bringing in the introduction of whole home DVR for free, which at one point Verizon was charging $20 a month, and I was paying that at one point. $20 a month for that service, that's incredibly high incremental EBITDA for the company. And you're seeing that sort of being competed away as well. So that seems to be the direction things are going.
I think you're a prime candidate for all this stuff. Tell us about DirecTV and talk about churn in the satellite world right now.
Yeah, so on the churn side, DirecTV specifically has talked about the potential for increasing churn over the next several quarters. And it's primarily, we've seen this sort of trade-off between DirecTV and Dish Network. And it seems like every other quarter or every couple of quarters, you see one company getting much more aggressive on going after, whether it's price points or free boxes, whatever it is, and then the next few quarters it reverses. DirecTV has had several very strong quarters in the U.S. that we think is going to start to reverse out over the next 3 or 4 quarters on sort of Dish winning back that share that they've lost over time. So you're seeing a normalization, but churn levels across the board are relatively low. Until we start to get into more aggressive pricing, you don't see the churn levels ticking up.
Well, the CEO of Dish Network, Joseph Clayton, he's going to be on Bloomberg West tonight with John Ehrlichman. So you're going to have to watch and find out what he has to say about this whole issue having to do with churn.
I'll tell you, I think the more interesting debate that people would rather hear is their long-term strategy and what they're doing with their wireless spectrum holdings. But,
what do you think? They're going to sell it?
Well, there's been a lot of debate about what's going on over at Sprint.
That's right.
And the relationship with LightSquared and whether or not there's a play here with a company like Metro PCS.
How long has that been rumored, though? I mean, people have been talking about a combination like that for years.
Well, the bull case on Sprint is right now centering in this idea that they've got a situation where they're losing subscribers every quarter, but this optionality, whether it's a combination with Dish and Metro PCS hosting their network, wireless network on Sprint, or LightSquared getting funded and moving over, or Clearwire coming in. So it's among our industry, it's been a very, very hot debate.
Well, with Clearwire specifically, how long can they last without additional funding?
Well, it's been a sort of a cat and dog fight. And we were in Kansas City last week meeting with the new CFO, Joe Utenauer, who came from
What did he
Quest.
tell you?
And I think their company view is that they're going to be much more conciliatory towards Clearwire. They've signed a contract with Clearwire that gets them through sort of 2013, and that will provide them some leeway that they're not pressured to do something, whether it be with LightSquared or feel pressure from Clearwire. But it does sound like the relationship will be different now. We've had a change in leadership at the CFO level. There's a view that maybe this is the direction they should go and not feel like they need LightSquared. From LightSquared's perspective, they've got some issues. They don't have funding, and they've got a spectrum position that has interference problems. So I think until you get over those humps or hurdles, it's going to be very hard to get excited about LightSquared coming on near term.
Time for one more. I know that you sit at home with your iPad, you watch video on that. We can't talk about cable and video and telecommunications without mentioning Apple and the iPad and the iPhone. What do those do to all the players? Disruption?
I think it's actually opportunity across the board. And we talked about over the top and how Netflix might impact the industry. Our view, and based upon the programmer relationships long-term with companies like Cablevision, Comcast, Time Warner Cable, and the satellite guys, they are the ones that own the relationships, own the content, they're buying the content. I think they're the ones that create the iPad application. So it'll be a Comcast or Cablevision app you're clicking on instead of a Netflix app that will eventually be able, once they get the rights, to deliver everything you're getting plus a whole lot more than Netflix. I think that's the real opportunity. I also would caution that it might not be Apple that you're carrying around. There's a tremendous number of tablets coming from other providers.
Sure, you might get from RIM, you might get something like the Playbook, or you might have something from an Android producer like an HTC or Samsung.
And I hear more and more people being disenfranchised as being locked into the Apple infrastructure. So Android might be the platform that becomes interesting over the next couple of years.
What would it take to get you to give up your iPad, though?
June 8th, I believe there's a new Samsung tablet coming out that I'm quite interested in.
So you're already lining up to get that.
Well, my phone, I just switched over to the Nexus S on Sprint, which is a Google-based phone with Android, and I think I'm going to probably move the rest of my ecosphere there as well.
Your ecosphere. See, I knew we should line you up and send you all the bills to test all this stuff out. A final thing for you, Time Warner, you mentioned that price increases, are they coming?
What we've seen across the board, which is actually very healthy for the industry. So if we're wrong and Netflix is the next coming, the savior for pay television, particularly really only on the cable side, but also in the telco side, is ARPU increases in high speed. Because what do you need
average
to get
revenue per user, yeah.
So average revenue per user is coming up because all of a sudden people are saying, wow, I need streaming high def on my iPad, on my TV, multiple. My kids need it too.
Of course they do.
And at 2 or 3 meg, you're not getting that. So we're seeing people moving up into these very high speed platforms, minimum, say 10 to 12 meg, but a year from now, 2 years from now, 50 meg might be the new norm. So now we're seeing ARPU increases, which drops right to the bottom line on EBITDA for the cable companies and the telcos, and that should be a huge benefit.
All right, I want to thank you very much, Mike McCormack, Senior Analyst, Managing Director, Nomura, telling us about the cable world.